And I'll say, Steve, to the degree that you might be able to communicate with Ross or Tricia.
I'm calling her. I'm not getting an answer.
Great. Okay. I hope she's not on the Google Meet.
Oh. I can join that on my phone. Let me see if she's on there. Oh, she's joining now.
Great. Thank you, ma'am. Hello, everyone, and welcome to this session where we are going to get much deeper into the layers and players of the BaaS space we use here in the industry for banking as a service. And we're going to get things kicked off here in just a moment with our distinguished panel that we have here in front of us. Welcome to everyone here. I'll be sure to allow you to introduce yourself and myself, more importantly, in just a moment as well, so that you just know who the person speaking to you is at this juncture. But why don't we go ahead and get started and talk just a little bit about what's in store for everyone today. If you are here to talk about transaction monitoring in the banking as a service or the BaaS space, you are in the right spot. So welcome to those of you that are joining us live here in the studio, as well as those of you that are watching this currently on LinkedIn and YouTube. And I will not forget those of you that are also going to be watching this replay. Thank you all for joining us and tuning in to hear about a topic that, let's be honest, it's not a new topic in the banking industry. I have been speaking about transaction monitoring since I was a banker myself, the early stages of my career, and also working within technology companies. But the conversation does need to shift when we start introducing it around banking as a service. And that's what we're going to get into here today as we get a little bit deeper. Now, if you have been keeping pace with us here at Ambassador, you know we are firmly in the RegTech space. And it's our goal over the course of the next several months to take you through the various layers of banking as a service and the players. And we're going to introduce you to some of those players here in the banking as a service space in just a few moments. So without further ado, if you are wondering a little bit about Ambassador, funny name, I get it, especially when you look at the spelling. It has a double A in there and a double S. That is intentional. We are spelling it as such because our goal is to help ensure that traditional community bankers out there that may be watching this have a resource that they can use to learn all about banking as a service. My goal personally, and Steve and I, our mission is that you are free to explore the concept, to learn about banking as a service, and then to make an educated decision on whether or not it makes sense for your organization. The answer, if it's no, is always okay. Our goal and our hope is just that it's an educated no at the end of the day. So here we go. We are going to get into those introductions as I promised. My name is Stacy Bishop. I am one of the individuals that have founded Ambassador alongside the handsome gentleman shown to my right on the screen, Mr. Steve Bishop. I will also be sharing the stage, Steve and myself, with Tricia Kathari, CEO of Unit 21, one of those players in the embedded banking space. And frankly, let's be clear, what Tricia and her team have built at Unit 21 is absolutely 100% applicable in the embedded banking space, but also transcends to the traditional side of your organization. So please pay attention to what Trisha has to say. You will not be disappointed. Also joining us is an individual that I am, Sarah Beth, so pleased to make your acquaintance as well, Sarah Beth Felix, a bit of a powerhouse. I'm not sure how you fit all of your accomplishments on a business card or all of the endeavors you have underway, Sarah Beth, but here in just a moment, I'll allow you and encourage you to share with everyone a little bit about those endeavors. So why don't we go ahead and start there, folks? Sarah Beth, since I was just chatting about you, would you care to share with us briefly a little bit about what you're focused on in and around this space, financial services?
Yeah, sure. Thank you so much for this great opportunity. I'm a huge fan of Trisha and Unit 21. I make no bones about that, and I am very happy to be here with you and Steve. So I've been in sanctions and AML since right after September 11th. I did a short stint as a stockbroker, but my whole career has been about how to operationalize especially for community banks, how to tackle some of the biggest inefficiencies and ineffectiveness that we see regarding sanctions and AML. So I get to work with global fintechs. I work with community banks. And, you know, I've been working with fintechs since before we even had the term, when they were just payment firms and they were just clearing their payments through these tier one banks, you know, 10, 15 years ago. And then now we have the term fintech, but, you know, which obviously directly plays into the BaaS space. You know, I get to, I don't know, you know, for me, I call it kind of like a 360 view of how money moves. In my spare time, I started a bank in Vermont with a great group of people.
Spare time. I love that.
But it was born out of what I saw as unfair de-risking crisis that was happening in island nations down in Antigua, specifically during 15, 16, and 17, when we saw mass de-risking from tier one banks to foreign financial institutions. And so that is part of the reason why we started down that path to start a bank, and it's kind of changed its face a little bit since then. But you know, everything comes back to sanctions and AML, at least for me. And then in my spare time, in my extra spare time, I get to train federal law enforcement agencies. I get to guest lecture at National War College and National Defense University on a whole host of topics, but specifically unregulated fintech payment ecosystems, which obviously has a transaction monitoring heavy component too. So I'll stop there.
No, and I appreciate you sharing all of that. And thank you so much for the information you also share publicly for those that are not able to attend some of those sessions that you referenced there in person, at least. You're very, very good about disseminating your knowledge amongst the space on LinkedIn. So please follow Sarah Beth if you are not already. I'll make certain that you also get her contact information at the end of our session. Thanks. Well, you've mentioned a lady here that I think we're all fans of, Trisha. I have been a fan of yours from afar and always a bit jealous that Steve knew you more personally. So thank you for joining, and thank you for sharing a bit of your morning with us. I'd love to hear about you and how Unit 21 came to be. What did you see addressed?
Yeah, Fusi, thank you so much for having me. I'm such a big fan of Steve and Stacy and what they're building for such a nebulous and relatively new space to provide the degree of clarity, to give confidence to banks to enter a new realm of growth. So really appreciate what you're doing for the community. And Sarah Beth, I don't know how she is one person in my mind. We're in the matrix, because she is definitely three people. So she is able to do so much. I really admire her. So with respect to Unit 21, I'm founder and CEO. When we started the company, what we realized is that there are a lot of legacy transaction monitoring providers. And a lot of the legacy transaction monitoring providers were companies that, while they were good, they didn't really work well for the BaaS space and for fintech companies. And so that was our main focus, is how can we enable fintech companies to be able to really create and customize their transaction monitoring rules. And then as BaaS started growing, we realized that this is very relevant for embedded banking. And today we're very fortunate to work with some of the biggest embedded banking players, as well as new companies that are just getting in the space. So that was the origin story. This is such a new space because while transaction monitoring has been around for a long time, the types of risks, the types of data that you have to analyze as you work with these different partners is so different. So really excited to dive more into today's webinar.
Well, we are excited to have you. And Steve, I want to thank you for being able to introduce the ladies first. Let me introduce you now to Steve Bishop, the gentleman that has changed my world in so many ways, introducing me to things like heavy metal when we were dating, Ironman events, and just the number of hours that a supporting person needs to spend out there. And most relevant to today's conversation, embedded banking. Because Steve, you went on a journey 4 or 5 years ago to learn everything you could about embedded banking, all of the layers and players. And the fact that we are a couple in and around the space meant that we were in this together, as we tend to approach most things. But you have this operational view as well, similar to Sarah Beth. And I'd love to hear, just if you wouldn't care, to share a bit about where you sit today and what just tell us how excited you are about the conversation. Lie if you have to. Don't worry. It's going to be out there for everyone to see forever. So lie well.
Well, I mean, I don't have to lie is the good news, because I think most people can say when they wake up in the morning, they're like, I can't wait to do AML and BSA. It's just like, exactly. It is a riveting conversation. It is. No, but it's such a pivotal part of this ecosystem. And when you think of embedded finance, like, it's easy to see the functionality, the front line, that customer experience, and how you're white labeling banking. But if you look at where banks have gone off the rails and gotten in trouble, it's largely been like the consent orders are largely around BSA and AML, and it's not that they were trying to do something wrong. They just couldn't keep up with the change in the industry and the new ways of doing business. So I am excited for this conversation. Great to have a conversation with Sarah Beth and Trisha. I've known a little bit longer and had some great conversations with her, and I know it's going to be a very educational time spent, and we're excited to be here.
And it will be. That is guaranteed, you all. And we are going to go ahead and get into these elements in and around what you've heard a preview of thus far. Before we do, though, again, my name is Stacy Bishop. I have been in and around the banking and the fintech space for my entire career, growing up inside this world, inside mainly one of the core providers, holding various roles there. I've always lived in this world in which I'm in the center between fintechs, selling and working with banks, and now for the past 5 years or so, banks now working and selling to fintech. So I am excited to be surrounded by this panel of experts, and we are going to go ahead and dig into it a little bit deeper. So here's what you can expect from our conversation today. I won't read each of these to you, but candidly, the conversation around transaction monitoring is imperative for any bank that is considering stepping off into the banking as a service space. When you are evaluating your tech stack, I encourage you to look deeper at this area and start pressure testing the ideas and the concepts that you'll hear this panel discuss today. If you're in the space right now and you find yourself overwhelmed by alerts and false positives and just generally questioning your life choices, this discussion is also for you, because we are going to get into more modern approaches and ways in which we can be thinking about transaction monitoring with a tool like Unit 21, and with the expertise and just great insights you'll hear from Sarah Beth and Steve as well. So we will chat about what sponsor banks are being asked to do and get more into those gaps that we see with traditional systems, some of which you've already heard. I want to reserve the most amount of time out here for our panel discussion. I have some brief supporting slides that we'll get into out here with our panel, but let's go ahead and dig into this first section. Why does transaction monitoring matter now? Well, I think we've already touched upon this, but at the risk of putting too fine a point on it, when you introduce fintech activity into your bank's transaction mix, the game changes, full stop. Because fintech activity and the end users being serviced by these fintechs, they behave differently. They behave much more erratically and at a velocity much higher than what we see with the traditional institutions' customers coming in through more predictable channels like check transactions or wires, digital banking channels as well. So while the channels themselves may be things that we're used to, using the same rules for these channels that we always have, but trying to make them work in a banking as a service or BaaS space could be one of those areas that causes you challenges down the road. And that's what we're gonna really speak in about just a little bit deeper, because when I think about this as a person that has seen more from an outside glimpse, banking as a service. I haven't been inside like Steve and Sarah Beth have, but I wager they would agree with me here that there's just more. When you are bringing on fintech partners, there's more of everything. There is more of those transactions you've heard our panelists speak about. There's a higher velocity of all of these types of transactions. And by association, because of that more, there's also more of the things that you come to expect as a result of this. More fraud, more false positives, more workload for your team members. It's just more things that we have to pay attention to, more noise, if you will. So when you take your current methodologies and try to stretch those into this space where there's more, that's where we start seeing hiccups. Now, I ran into this statistic, and I'll share with you a little bit more about the context of this stat, but it struck me last week when I saw it. 85 to 99% of legacy alerts are false positives. Now, in defense, this article that I read this last week was published back in 2018. So that's 7 years ago. And at first I was going to just completely dismiss this. But then I sat back and I started wondering just how many banks that might be watching this presentation right now, or others that might watch this later, how many have actually changed their BSA, their AML systems in the past 7 years? I don't know that that number is exceptionally high when we look at the 9,700 FIs that we have in the country. I don't have any data around that. I haven't found any information there, but I would wager it's a fraction of the banks that we have available in the States right now. Panelists, I'm not sure if you have a thought on that or more inside knowledge. I bring this up because even though this staggering statistic that stopped me in my tracks is dated, I wonder how topical it is. And I would suspect it's still very topical that there are many banks using more legacy rules-based systems, that what I used to pitch, the rules-based systems in the early stages of my career that are dealing with large influxes of this activity. I don't know, Trisha or Sarah Beth or Steve, do you have a different take on this? Do you have any insight into just how many banks are switching out TM systems? I know I'm catching you off guard.
Yeah, I mean, it's a great question, and I can dive in because we have today 8 products on the post-identity verification side of things, and our core products include transaction monitoring for both AML and fraud. And it's very unfortunate, but the statistic hasn't changed in the last 7 years. And it's very difficult. What we find is that while banks do not obviously think that this is a problem, they haven't really put the energy, the resources to truly prioritize making a change. But we find that the ones that actually do prioritize, they see such a dramatic improvement, and they're able to put their resources into more strategic work that the lift it has on the banks, not just only AML and risk programs, but in general, the growth profile of the bank is significantly different if they decide to make a change here.
That makes sense. Go ahead, Sarah Beth.
I would completely agree with that. I think part of the issue is that many years ago, when they tried to solve for this bad efficiency rating, which I will say is the majority of what I find. I do a lot of model validations, and the majority of community banks are in that like 2 to 4% effectiveness, which is the inverse in the statistic on the front here. But I think it's been an incorrect way that we kind of point the blame, and we point it at rules-based systems. And I think the issue is not a rules-based system. I think it's the fact that we don't have the tools to customize to the threats of the institution. And I say this a lot, and that's actually one of the reasons why I like Unit 21, and I do recommend them to a lot of my clients. And it's not ever because there's no compensation. Tris can talk about that. There's referral fee. It's because I've seen it work. You can tailor your approach to the threats of your institution instead of just having this kind of nebulous form of rules that may or may not apply to you, and you can't really tailor it to the threats that are within your customer base. And so that I think has been one of the issues. Everyone kind of says, oh, rules bad, behavior good. And it's like, no, the tool matters, and the way that it should equip you to find the threats within your transaction and customer base. So
that makes sense. I do want to pull on that string a little deeper when we get into the more of a transaction or rules-based discussion. So I'll return back to this conversation because that's an interesting nuance you just pulled out there. Steve, I'll save a question for you, kind sir, as we continue going on here. But I do want to mention that in the same Celent study from 2018, there was a stat that was staggering: 3,000 to 4,000 employees being employed at the largest banks in our nation, devoted to BSA and AML work. And the average reconciliation time to work through their cases was about 30 minutes on average. So the sheer scale and scope, yes, in a large bank environment, but I think even as we heard from our panelists, in all banks that are working with more traditional systems when it comes to AML and BSA transaction monitoring as a whole, there's a lot that you have to wade through, a lot of noise that could be distracting your teams and inundating them, and just, again, causing them to question those life choices. So the ultimate challenge that we see, or that at least one of those that I see from my seat, is that these legacy systems were built for more predictable patterns. So this is kind of where we get into that rules-based discussion as well. You just heard Sarah Beth kind of illustrate a bit differently about why it is perhaps not as much the rule-based solution that's the problem, but perhaps the tech or the tool. I will say this: we're very good as an industry about sharing what types of rules matter to bankers and disseminating information to bankers about transaction limits and when to file SARs and the activity that needs to occur in order for a SAR to be filed. I would suspect that we're equally good at an industry at educating those people, those bad actors that are trying to pass through illicit activity, structure transactions, and basically get around those more traditional transactional systems, those more rules-based systems. I would love to hear someone's view on that, and if you think that I might be mistaken there, but I do think we definitely aid these individuals in taking advantage of us by trying to help ourselves as well. Thoughts on that? Steve, I'll turn this one to you since I didn't ask you to comment the last time.
I don't know that I disagree with you, as I'd like to find some sort of angle that not with you, because you're always right. But no, I think, if you look at the legacy systems and the rule-based, it is absolutely the fraudsters are just getting smarter and the tools are getting better. And if you have a predictable rule, it also is predictable to break. And so, I really don't have anything different to say, but we can check with the experts for the legitimate.
Yeah. Ladies.
Yeah, I can share a little bit about, one of the things that we recently launched in our transaction monitoring rules were that how can we look at the true positive and false positive dispositions and have AI provide recommendations on how you should tune those rules. But what we find is that the challenge with rules is they're implemented and no one touches them for a year. And then they're touched after the next exam or before the next audit season. So to your point, then they end up becoming very ineffective. And that's where we find a good use of AI is rules work because rules are explainable. You can explain to a regulator what exactly you were doing, which is very important. But AI is really helpful because you don't have the resources, you don't have the time or energy to continue to keep tuning your rules every week. But AI can do that for you and can show you, okay, this is how you should tune your thresholds. So it's really important. We found after we released this, the interest was so immense in this functionality within our transaction monitoring system that we realized that this is a really good application of AI, not black box, but really something you can control, something that leverages your data to be able to make more effective rules.
Love it.
I think for me, again, this probably isn't the most popular opinion, but I think it comes down to the tool, because while legacy, your slide that you have, the legacy issue with the predictable patterns, that comes down to how many conditions can you write in a rule, deploy it in a sandbox, test it, and then make it live. Every other legacy monitoring system that's out there that's rules-based is not a multi-conditional, let me equip the financial institution to experience fraud or experience, what they believe to be human trafficking typology and go out and write a multi-conditional rule in a no-code environment, deploy it to your sandbox, test it, and then make it live. There's not a single, and that's where, again, it comes down to how the tool equips financial institutions to be nimble, to get out ahead of, I think other than the fraud typologies that we see published from FinCEN, we have to kind of wait to see, all right, well, what does it look like? But then all those things have to incorporate different data points, either about the customer or the transaction or the description in the ACH or the time that it occurred and all these things. Well, all of those things feed into conditional components in a rule that if you're stuck in a legacy system, you can't tailor any of those data points for the fraud that you went through. You just have to rely on whatever the system is doing. And that's where I think that's, again, and I mean, I feel like I'm a cheerleader for Trisha, but I mean, and it's because I say this all the time. That is one of the things that I love about what Trisha has done is it equips financial institutions. It, like a 13-year-old daughter could write a no-code multi-conditional in a Unit 21 environment. I like that.
Yeah, I like that as well. That was a comment that I had read a few weeks ago preparing for this webinar, was that many systems make it so complex. So let me touch on this from a couple of different angles. Trisha, I agree with you completely. Something that you mentioned where many bankers, they're flying by the seat of their pants. You have customers to administer to. You have your day job. Keeping track of system parameters or changing rules may not be something you do every day, may not be something you do every month, may be something you do every year or whenever there's some new rule or condition we need to monitor. So you almost have to get yourself in the frame of mind again to go in and say, all right, where do I go to do this? It's not extremely intuitive. And so what I read an article a few weeks ago was simply how unintuitive the more traditional legacy systems were as well. various buttons. It's like a mission control for a BSA AML team to try to figure their way through exactly what Sarah Beth has illustrated. This approach that has multiple conditions, and it's very difficult to try to do, and very difficult to try to do in those more traditional legacy types of layouts and environments. So I just wanted to make that point for something that both of you ladies said there, that it's a challenge. It's a challenge all around for individuals that are trying to keep up with AML and BSA alongside their day job. And keeping track of these systems may not exactly be that day job. It may not be extremely intuitive. It may not be something, Sarah Beth, that your daughter can do with these more traditional systems like she could with a tool like Unit 21. All right. Well, I do want to ask a question specifically to Trisha. All right. Are you ready, Trisha? How should a bank, or maybe I'll ask this from your viewpoint as a technologist, how do you think about building monitoring that adapts fast enough for a modern banker to keep pace with these fraudsters?
Yeah, it's a great question. And what we find with, let's say, traditional bank versus sponsor bank. A traditional bank has one customer base. Maybe you know them, maybe you've met them in person. You have, your products, you have a checking account, a savings account, a mortgage product, etc. And you're providing those. When you become a sponsor bank, you might work with different types of fintech partners. One might provide a debit card for teenagers. One might provide a retirement account for the elderly. One might provide a cross-border payments for between the US and Latin America. Now you have three very different sets of customers who you do not know at all, and you've never met them. You're providing extremely different products to all of them. And that's where we see there's a big breakdown for sponsor banks, because traditional legacy vendors were not built for this. They were built for your checking accounts, their savings account products. And this is where for sponsor banks, things really start breaking down in that collaboration, in the edge of the collaboration at the seams between the fintech and the sponsor bank. So in terms of really what should a sponsor bank do, there are really three major tools. The first is the data that you're collecting encapsulate the business model of the fintechs you're supporting. So as an example, if you are providing, if you're helping, if you are the sponsor bank for a debit card for teenagers, you need to get information, not just the card transaction information, but the information about the child, maybe the parent or the guardian, etc. Versus if you are doing cross-border payments, then you need to get information about the jurisdiction, the currency, the use case, the memo note. So it's very important to make sure that you have a data infrastructure where you are getting the specific data that encapsulate the business model for each of your fintechs. The second is one size fits none. The rules need to be different per fintech. If you have one rule, which is like, okay, monitor for behavioral changes, cross-border payments may have very different behavioral changes. Seasonality, where people are giving money during Christmas, is far more normal than for a debit card for teenagers, where it may not be as pronounced. And so it's really important to be able to customize your rule sets, because the types of risks that a retirement savings account is going to have is going to be very different than a cross-border payments company is going to have.
Excellent point.
And the third, and just maybe to wrap it up, the third I would say is a very important collaboration between the sponsor bank and the fintech. For thanks to 2023, there's been a little more clarity in this, but it's still sponsor banks think that, oh, no, we will do all of the monitoring. And it's like the risk actually the fintech companies know. So you have to have that close collaboration.
It's so true. And what you've mentioned leads beautifully into our next section, where we're going to get into what sponsor banks are being asked to do. So I hope you picked up on those 3 tips that Trisha just provided there, because we're going to get into those a little bit deeper. So sponsor banks, as you heard, you must now just do more. This whole webinar is the theme of more. So monitoring transactions and activity across multiple fintech partners, maintaining specific rule sets and thresholds for partners. You heard Trisha give a great example about a debit card for teens needs a different type of approach and rule set than you would use for cross-border payments or something entirely different. We do need to make certain that in today's banking as a service environment, that sponsor banks are equipped to just detect new patterns faster, and that we can do so in such a way that Sarah Beth, your daughter, can easily implement, or any other overworked banker in today's environment has the ability to do the same. And another point that you heard Trisha mention, the ability to collaborate with your fintech partners almost in a real-time fashion is paramount to what we're getting into in today's transaction monitoring in the banking as a service space, folks. So did I mention that you also need to be able to just demonstrate that you have a degree of oversight to your examiners whenever it comes down to this situation? Extremely, and get into this as well. So I have a question here, Beth, for you and for Steve. What kind of do you two think has to occur inside a bank before any monitoring tool or process has a chance of working? And Sarah Beth, I'll start with you. Ladies first, Steve. Again, you're such a gentleman.
Thank you, Steve. Let me go first. I think the mindset that I see that works well for scalability, especially, because if you're going to start a BaaS program, you don't want to just have one client that, you will constantly be in the red, and that's not good. So I think the mindset that has to shift is, I own this, and now I am responsible for figuring out the threats and vulnerabilities that are 3 layers removed from me as the sponsor bank. And the way that you do that, the best way that I've seen that light bulb moment is thinking like a criminal. And I say this all the time. You have to think like a criminal first. And so when a fintech comes to you as a bank, if you ask them, how would a criminal use your product to send funds to LATAM or to issue a card to a teenager? It's a great conversation to have with a fintech, because it teaches that fintech maybe to shore some of their controls, but then it also is a sponsor bank, and I hold the majority of the risk as a hyper-regulated financial institution. So then I need to go through that exercise. I need to do, some type of pen testing, informal pen testing, if you will. If they have complete remote onboarding, can I change my IP address to, an Eastern Bloc country? Can I actually go through the app process on that fintech's site? Right? There's a whole bunch of exercises that come out of that mindset shift of, how would a criminal exploit my fintech's products? And I think that's missing a lot of the times, because once you start down that path and you start looking under those rocks, you can never unsee that stuff. And once you see it, then you have to go, well, the tool that I have doesn't allow me to actually tailor or look for this particular threat typology that I just identified. And then that, leads you down the path of getting better technology.
Oh, that's so good. Well, Steve, I know I sometimes accuse you of having a devious mind, and I've heard the stories about you finding the loopholes and breaking the rules as you were coming up through elementary school and middle school, and I'm sure even into college and grad school. So what does that pull out for you from what Sarah Beth has mentioned, or your own thoughts on this question?
Yeah, well, I was a very good kid, for the record. It was a great story in high school when I reprogrammed a network sign-on, which I thought was hilarious. The teacher did not. However, no, I think Sarah had excellent points. I think if you back up in the life cycle, like, why is Ambassador? Why do we start this? banks don't like to change. And so I've heard it said many times, we've made a lot of money doing the same thing for a lot of years. So why would I change now? And like, not to get on that soapbox, but so that's the hurdle. You have to educate about why that change and why do you get in fintechs? And then like, you get specifically to AML and BSA and the monitoring. It wasn't that long ago I was at a bank that had just went from a manual process to one of the legacy systems we've been alluding to. And like the regulators, they love it because they have some sort of system in place that's doing it. They can handle those 99% false positives and it's fine. So once you get that thumbs up from the examiner, you don't want to change. Like, why would I change? I've got some of the regulators I don't want to upset them. And it's,
when you say that the bank went from the manual process to more of a legacy system, the examiners loved it, just dealing with the 99%. Are you saying they just like kind of threw people at it, threw time at it? I gotcha. Through time and energy at it.
So going from nothing to a legacy system.
It was an improvement. Gotcha.
It was an improvement. So examiners saw the improvement, gave it a thumbs up. And so now you have that hurdle of you need to change to get to something that adapts with your new business model. So it's part of the whole educational shift in mindset of, I'm not just going to do traditional banking where customers come to me. I'm going to adapt to this new world where we take our products to the customers. And that's like, as that you do that, you have to be much more adaptive. Your product is adapting, and so will the fraudsters. And so you have to find those tools that can help you make the necessary changes as well.
Okay, that's fair. For the record, ladies and gentlemen, there was also an instance where Steve in his professional life did change some sort of a conversion program on the implementation team side. I think that folks had to deal with and look at. We won't get into it today, but
that was a change for good. It's still used this day. Yes.
All right. Well, we'll get into that'll be a conversation for an event if we see you all at an event coming up this spring. But I do want to now transition into this whole gap that we keep talking about. You just heard Steve mention that moving from a manual process to a legacy system was an improvement, and dealing with the 85 to 99% of false positives was such an improvement that it was welcome to the bankers and welcomed by the regulators. But there's still this huge gap. And that was a sponsor bank scenario, Steve, correct? Where the sponsor bank was moving, that you'd worked out, moved from the manual.
They had the legacy in place by the time that they went to sponsor banking. But
got it.
Even then, it was like, we don't need to change.
Gotcha. So there's still this gap then as you were launching the banking as a service side of that institution into what is available with a solution like Unit 21. And some of these gaps are astounding. I did find this stat interesting, you all. 64% BaaS bank regulatory actions have focused on AML type of shortfalls. And these can be just failure to notice and catch transactions, untimely SAR filings because you're just inundated with this data and all of the noise that we've been chatting about. That is a staggering figure to me around this very important conversation, because transaction monitoring and what we're describing touches every layer of the banking as a service model. And as we've been describing here throughout this entire conversation thus far, those traditional transaction or legacy systems, they were designed for some of the batch processing that we see between core providers and their systems, or very linear types of customer behavior, those known risk patterns we see commonly through channels, checks, others, wires. And this has limited data sources, not in a fashion that is indicative of a limitation, but a smaller number of data sources. Meaning that when you expand in the fintech relationships, boy, the game changes quite a bit, as well as when we introduce faster payment channels, which we hadn't even touched upon just yet in this discussion. That absolutely, in and of itself, the faster payment channels are a great indication of why you should be thinking about a more modern type of transaction monitoring system. These systems themselves, these legacy systems, were not designed for some of the things that we have been chatting about, the hyper volumes that we see, the smaller transaction figures, these bad actors in other areas of the world that might be trying to take advantage of fintech and or your bank itself. And this multi-tenant nature supported by multiple fintechs reporting up to one overall FI, also not something that many of those systems, those legacy platforms were created for. So now I just want to switch gears and get more into the panel discussion and really flip the conversation into how we can start just digging into some questions, you all, because we have about 17 minutes left and I have questions for each of you, burning questions. So here we go, you guys. What actually works? Like, I want to get into this for a bank that is sitting with a legacy system. Perhaps they're fine with the status quo. They're throwing people or time at an issue. What can be done for these individuals if there's a baby step to keep them from getting overwhelmed? Sarah Beth, I might ask you to start with this one because I know you're very pragmatic in your approach. Do you see like a baby step between a legacy system and a modern type of system like Unit 21, which I know you love?
I mean,
thing?
Yeah. I mean, the baby step is that exercise. You know, that criminal mindset serves a non-BaaS bank. So, you know, to me, if there's a BaaS bank that's going from a non-BaaS position to a BaaS position, and they've never actually done that with their normal retail side, their normal commercial banking side, I think for me, that is the baby step. I mean, it's quite a big baby, but I mean, it's still a baby step.
It's a 12-pounder for sure.
Yeah. But I think that's probably one of the things, because a lot of the feelings of being overwhelmed, they come back to unknowns. It's like, well, I can't really see out ahead of when we onboard this fintech. Well, yeah. One of the ways, not complete, but one of the ways in which you can get out ahead of some of the threats and risks that are embedded in that fintech is by going through that baby step of thinking like a criminal. How will this debit card, will this payment, how will that individual from that part of the world, you know, walk through that thing of, all right, this is Jeff Epstein Jr. and they're trying to use this platform to finance whatever they're doing. And so there's different steps like that I think give confidence, but also kind of but kind of diminishes some of the feelings of being overwhelmed, because you're closing that I don't know what I don't know gap, and you're moving through that quadrant of, oh, well, now I know what I don't know, and then now I know what I know. And that I think plays directly into feeling overwhelmed.
No, I like that. That makes perfect sense. I do think sometimes that feeling of overwhelm or that uncertainty is a reason that many banks would use to say no to banking as a service as well. But I hope if you have found yourself in that category before, where you are sitting behind that question, or you're thinking in terms of, oh my gosh, we bring on fintechs and we just won't be able to handle it. I hope what you're hearing is that there is a path forward, and doesn't have to be an immediate rip and replace. You can start thinking like those illicit those bad actors conducting illicit activity, and Jeffrey Epstein Jr. You can start thinking like those individuals. Perfect example there. All right, well, this one here is for each and every one of our panelists. Are there any early warning signs that you have seen personally in Steve and Sarah Beth at your own institutions you've worked at, or Trisha, that you all have seen from the Unit 21 side that tell you, wow, this is the time a bank should be considering a move to a more modern transaction monitoring system? Any signs you guys can see, leading indicators that we should make the audience aware of?
The biggest one that we've seen is the banks that struggle are the ones that accept alert growth as inevitable and false positives as inevitable. And for us, in the data, what we see is that they have no program level segmentation. So that is the biggest telltale, is that they treat all of their programs in a very similar manner, don't do anything different.
Okay, that's great. So that kind of goes back to that question or that comment that Sarah Beth made earlier. Sit down with a fintech that you're bringing on board and start asking, how would someone take advantage of you? How could someone defraud you if they were in, I think you mentioned LATAM or other areas of the country? How could they take advantage? And then start building specific rules there. And then use your own organizational FI knowledge. I think I hear you saying, Trisha, where you say, okay, based on this teen debit card activity, we also need to impose our own additional types of controls and profiles on this particular fintech. And it's absolutely fine. And in fact, expected that it looks different for every single fintech that you onboard. And that's how you prevent that overwhelm and those false positives from getting out of control.
I think for me, there's two indicators that I look for in just initial conversations with boards and executives at banks. You know, I ask them what they've done with data. I ask them if they have data folks, just any data folks, not in the AML team, but just any data folks. And if their answer is no, then I'm like, you do not go down this path until you remedy some of the basic issues. You don't have NAICS codes collected. You clearly don't care about data. And it all came down to data. So if you don't see data as a critical piece of your bank as a whole, then BaaS is going to be very difficult for you. The second question I ask is, how many SARs have you filed on anything other than structuring and fraud? Nothing. Then I say, well, then you're clearly not ready for this yet. You need to get your team used to looking for transnational criminal organizations. You need to get your teams used to looking for cartel activity and human trafficking and drug trafficking and terrorist financing. If you've been around for 40 years and you've never filed a SAR on human trafficking, then you're missing it. And then you want to add something super complex that's removed 2, 3, 4 layers down. That to me, those basic things need to be tackled first. And then that sets you up perfectly for a successful, scalable BaaS program.
Makes perfect sense. Steve, you have been quiet. Any thoughts on this question?
They stole the words right out of my mouth. I was actually going to say verbatim exactly what was just shared. No, to Sarah Beth's point, the executives, the board, the vision that you're painting as far as where you're going with embedded finance, having the diligence package and working through that so you truly understand that funds flow, so you can really set this up where it's going to catch the bad actors or identify them, and having the mindset that you're going to have to be better, and like scaling, you don't want to scale up false positives. You want to maintain that to Trisha's point. So it comes down to, it's not an early warning sign. It's that early preparation will set you up for long-term success.
Very good. Well, let me ask you this one, you all. If there are banks that have been participating in this conversation and they are convinced that they need to consider moving transaction monitoring and they need to start thinking more in terms of modern systems, any advice for them as they're working with examiners as far as this evolving in real time, how that confidence or any communication that should take place? Or will the examiners just be so pleased that it's no longer manual or legacy? What do you guys think?
It's a great question. What we have found, and we've been, and I mentioned this in one of my comments on the group chat, but all our banks go through exams. And so at this point, we've gone through hundreds of exams over the last several years. And what we find, examiners really like it when the relationship and the collaboration between the bank and fintech is healthy. And the biggest breakdown that we see is if there's a fragmented ownership. So banks will see the alerts, but the fintechs are actually close to the customer behavior. They actually know what is going on. And in the strongest programs that we work with, it's a shared control plane. Of course, the bank is responsible in the back, but the collaboration is really significant between the bank and the fintech.
Thank you. Well, I know we're almost here time. We have 7 minutes left, and I want to make sure that everyone knows how to connect with every one of those panelists that we have here being featured. So I'm going to ask one final question. We are here at the end of the year, ladies. By the way, if I had 30 more minutes, I could keep you guys here for 30 more minutes. If I had 3 hours, I could keep you here for 3 hours. But the final question here today, any thoughts on what the regulators are going to be paying attention to in 2026 around this topic of transaction monitoring? Any thoughts, crystal ball type of moments?
I mean, I guess I'll start with mine because it's never positive. And then I'll let someone else close with something positive. I think unfortunately what we're seeing is a de-emphasis on AML as a whole, regardless of whether or not you're non-BaaS or BaaS. We will not see closing of regulatory frameworks that govern fintechs, which is unfortunate. I've long lobbied for that. Like we're talking about a decade on regulating unregulated payment ecosystems, which about half of the fintechs in the US are. And then the other half fall under our 40-year-old MSB laws, and then some state remitter laws, which are old and they're not made for how money moves today. So I don't see this being a huge focus. I know we just came out of like this being like the hot button for several years in terms of what examiners are focused on. I will say a lot of my clients who are BaaS banks have already been straight up told, just give us a copy of your audit and a copy of your fintech's audits, and we'll call it good. And that's alarming. It's a wee bit discouraging because it's not that like they're doing that because suspicious activity is, going away. That's not it at all. It's just a shift in priorities. So I think my crystal ball for 2026 and beyond, is not, I think a lot of the BaaS teams will lose the impetus behind what they need in terms of new technology and saying no to this fintech and saying yes to that fintech instead, because the regulator's pressure is off. And I think that's an unfortunate situation. But the reminder is that everything we do and don't do today, we're going to be held responsible for under the next administration and their set of priorities that they have. So, I would continuously say that to your board if you are already feeling like that. If you're already feeling like they're taking stuff from you, that you have to remind them. There's also a little asterisk, and then I'll stop talking. There's a DOJ component to this as well. We know that the DOJ has now stepped in, has made sanctions, right? There's now a criminal heaviness to sanctions and FTOs and STGTs. And I think that's something that a lot of community banks, especially BaaS banks and their fintech partners, don't take seriously enough. So while your bank examiners may not be, super focused on it like the time we just came out of, there's still a DOJ criminal loose site.
Well, thank you for that, Trisha and Steve. I'm gonna stop you all from commenting only because there's a question. Oh, Trisha, you answered the question for Inman out there in the chat, and that the question was if Unit 21 tracks people or aggregates information across various fintech programs inside a sponsor bank. And for anyone that is dying to know the answer to that question, Trisha offered that answer is yes. At Unit 21, they do track transaction movement and those types of activities across programs. Now, you all, here we are at the end. I want to make certain you know a little bit more about these people, and I want to make certain that you know that from the ambassador side, we try to be of service, providing smart, intelligent conversations with voices like you've heard today with Trisha and Sarah Beth, and of course, Steve as well, and then trying to meet you where you are. If you're not ready to have conversations with organizations like Unit 21, that's okay. They will be there when you need them. In the meantime, you can connect with them on LinkedIn as well as Sarah Beth, or follow some of the information we place out from the ambassador side. We will also help, as you also heard Sarah Beth say, we know people that can help you speak to your board intelligently about the banking as a service option. So reach out, connect with us. We're happy to be a connector and a servant of this space. Coming up next, the next webinar we'll do after the first of the year, staying in the reg tech stack, getting into the identity portion of the bank fintech relationship. Want to know where to find these people? Well, you can reach out to any of us on LinkedIn, myself and Steve, and the ladies that we have joining us here, Trisha in Unit 21 and Sarah Beth. All right, I think we have 1 minute left. Any final words of wisdom from our panelists?
I'll just say thank you to Sarah Beth and Trisha for joining us today. And thank you for everyone watching, whether live or on a replay. And hope everyone has a happy holidays. We can't wait to see you for the Identity Solutions in January.
Thank you very much, Trisha, Sarah Beth. You two are fantastic. Again, follow these ladies on LinkedIn, reach out to them. They are, if you couldn't pick it up, they know more about transaction monitoring than those bad actors out there. So make sure you have them on your side. And with that, I'm going to wish you each a wonderful rest of your day and a strong close to December and whatever that means and looks like for your business. Bye, everyone.
Thank you.